Okay, so let's start. It's nice to have you here today with us. We have a nice and lively program, I think, in the coming 50 minutes, as each of us will be introducing ourselves, so you can understand why we are participating here. And as you will see, we have a very diverse panel from various backgrounds. So I think it's going to be interesting for you. Let's go first to each of the panel members. I'll start with you, Judith Gu. If you could please introduce yourself.
Sure. Hi, good afternoon. Good afternoon from New York. My name is Judith Gu. I joined Bank of Nova Scotia, a Canadian bank, also known as the Scotia Bank, 3 years ago. And my mandate is to build the electronification of high-touch market making. I'm very happy to join the panel and talk about how quantitative approach has impacted the fundamental work process on a trading desk.
Good. And next we have Jonathan Berkow.
Hi, I'm Jonathan Burko. I'm the Director of Data Science at AllianceBernstein, and my role is to really bring alternative data and data science tools to all of our investors, whether or not they're fundamental investors or they're quantitative or systematic investors. So we'll be talking about our journey and how we've brought the quantitative tools to both of those different groups.
Good. And you, Marko, Kangrga, you are now a star because you are not with the first panel. You have been already having some time before. Can you just introduce again yourself?
Sure thing. Yeah, I'm Marko Congrega. I'm the head of quant research within data science at RavenPack, and I've been with the firm close to 2 years now. And prior to that, I was on the buy side at an event-driven hedge fund in New York for 9 years as the head trader and investment analyst. So now my efforts are mainly directed at putting our heads together to bridge the gap between purely systematic quantitative investing and kind of more discretionary fundamental approaches.
Perfect. And me, I am Jean-Philippe Olivier. I'm based in Paris, and I've been working for BNP Paribas Asset Management for the past 16 years in various positions in the MAQS division. The MAQS stands for Multi-Asset, Quantitative and Solutions, and we manage about 150 billion around in such quantamental strategies. It's roughly 1/3 of all of the assets under management of BNP Paribas Asset Management. So today, we'll share together the topic of the panel, which is the journey of embedding quant methods within your your fundamental approach. With such a diverse horizon of each panelist, I can imagine everyone will have various and different opinions. So I'll start with a very general question, which is why should we embed quant methods in a fundamental approach? In two simple words, it's why quantamental, and maybe you've often heard about that question. And just to kickstart and leave then after the other panelists, I will give a short answer on three points. Why quantamental? It's because of enhanced returns over the long term. It's the use of big data and quantitative signals to help in the screening of a wide range of securities and markets. The second one is because of the portfolio construction and risk control, we can use quantitative tools which are useful when it comes to sizing trades in an efficient and disciplined manner. So for instance, we have developed an internal tool where we are using risk budgeting techniques on our side, and you will see other panelists explaining what they are doing. And besides, you will understand that the experience and the skill of analysts and portfolio managers provide a very useful insight into how to navigate those different market environments. And the last and third reason why quantamental is transparency, because quantamental in our way, the capacity to have both systematic strategies and our judgmental approach when we will see exactly when we need to use that that quantamental approach offers investors greater visibility with regards to portfolio behavior and what we are doing in their portfolios. I said there in this short answer, and anyone from the panel would like to comment further about why quantamental, why we should be using quantamental, why we're so convinced?
Yeah, I think you highlighted the example of adding enhanced returns as your first point for why quantamental may be interesting. But I would drill down to that a little bit more and say it's really about adding orthogonal sources of returns, giving your PMs or your analysts or your quants another that signal for value that may be not as additive to their process as saying, oh, well, we can look at sentiment from social media, or we can look at the prices of products on certain websites that can really give you an edge and answer your answer your question with new information they didn't have before. And so really, I think that the main reason why many investors are looking for quantamental is really about that orthogonal return component, as opposed to just adding another definition of value or another definition of momentum. It's really about finding something that they didn't have or even wasn't available to them 5 or 10 years ago.
Good. Marko or Judith, any other point of view?
I think it's well captured by both of you. I just want to echo that because the return is driven by many factors, many forces, not just fundamentals, but also macros, the news flows, the sentiment. So capture all of that in a way that our strategy is always in tune with the market, with all those factors. Quantitative approach just provides a very scalable way of doing that through the machinery, through the algorithms. So yes, it really just enhanced the human effort, as we don't have enough people to look at all those factors comprehensively all the time. So yes, I think quantitative is really now in the mainstream now.
Mm-hmm. Certainly, and mainstream is a good point, because the word quantamental actually, besides very rare occurrences on Google, I Googled that for some time. We don't think we coined the term on our side, but definitely we were quite early in terms of trying to share that idea about mixing quantitative with human judgment. And so for the past 5 years, we have been trying to be spreading the word, evangelizing, and so because if we are looking back, if we are projecting ourselves, I think that by the next 10 to 15 years, everyone will be in some way talking about quantamental, talking about adding quantitative strategies in their normal process. Marko, any more comment about that?
Yeah, it's been fairly encapsulated fairly well. I think it's kind of important to understand, I think, the pervasiveness of that paradox of skill, which is that as overall the level of skill improves in the market, the more money comes in, more competition comes in, it's harder to grind out excess returns. And we've kind of seen that with the discretionary fundamental investing. It used to be enough to just kind of build a model and invest in a company based on valuation. And as more money and players came in, that obviously required a bit more creativity. That same is happening in the quant front. And I think quantamental is kind of a fuzzy term that I don't think has a very neat definition. But I think that's what opens that up to creativity, which we'll obviously talk about in a bit. But that's why I like that quote from Keynes, that worldly wisdom teaches better to fail conventionally than to succeed unconventionally, which is why I think historically, or at least over the past few years, a lot of funds have been antsy about kind of getting on the quantamental train without really knowing what it really means. Yeah. So I think it's here to stay for various reasons.
Okay, we'll look further in the reasons, I guess, about why we think it's going to be there for long. So let's go more with specific questions, and I will start with you, Jonathan. From your experience, why is it important to start from fundamental questions?
Yeah, I think that one of the challenges that we have actually in the space in getting an adoption of quantum million strategies is actually the news media. And one of the challenges that they've caused is that they really make everything seem like a silver bullet. If you can find transaction data, or if you can find news sentiment, that's going to be the be all end all. And what we've tried to do, and really tried to work with our analysts to do, is to show them that this is just especially for fundamental analysts, this is just another piece of the mosaic. It's a tool to help you answer a specific question. And because these analysts really are question-driven analysts, especially on the fundamental side, where they may have a view about a stock, but they want to be able to answer that question about the stock's prospects over the next 5 years. And there could be a question or a controversy that they want to be able to answer that we can use data science tools to help them answer. And so there are many, many examples that we have, whether it's scraping prices from different websites, or actually one story that I can share that's sort of an old story. Once upon a time, about 50 years ago, there was actually an analyst who was curious about the McDonald's growth prospects. And so what he did, he was creative and just wanted to know how fast McDonald's was growing above and beyond what it was reporting to in its quarterly earnings. So this McDonald's analyst went to the McDonald's and bought a cup of coffee every month, because he figured out that on that receipt, there was a number, and that number didn't reset for a long period of time. So you could go and buy a cup of coffee once a month, look at your receipt number, and then know exactly how many receipts had happened since the previous month. And that was actually the analyst having a real question, and then also being creative, and then be able to figure out how can I get in my edge and get my extra piece of data, or my alternative data at the time, or it was just the McDonald's receipt. But that really gave him an edge, and it helped him answer a specific question about the growth prospects of McDonald's. And so starting with that question really helps the analysts link back alternative data and data science to something that they understand, which is deep fundamental analysis.
I love this story about the receipt from McDonald's. It's really corresponding to exactly what we are looking at, alternative data, but where do we get these? And I think you are particularly working with web scraping as well. How is that useful for fundamental analysts as well?
Yeah, I think for fundamental analysis or analysts, what's valuable about them is they have all these interesting bespoke hypotheses, and each one is different. And you may not be able to just buy a data set off the shelf that can help you answer any one specific question. So what we have are very scalable tools to help us web scrape many, many different kinds of websites to help them answer their very narrow question. Someone may be concerned about pricing across these 5 different websites. Someone else may be concerned about the sentiment of people talking about a product on Reddit. And so we have the tools to be able to help them answer their specific questions. And the data science techniques or tools that we have is just web scraping. But one of the things that's a real challenge is just making sure that these analysts understand that the data is out there. And so the phrase that we like to use is this phrase called vujade, which is actually the opposite of deja vu. Deja vu is seeing the same thing and again, but vujade means to see the same thing, but see it in a different way. And so we want our analysts to all look at the digital world around them and find their own McDonald's receipts or their own email receipts or websites to scrape, because it's all out there and we all understand it, but it's really a challenge to help them be creative so that they can really lead us to the answer when we need to web scrape something. So, I would encourage everyone here to just take a fresh look at things and think of the world through vujade instead of deja vu.
Yeah, very good. Vujade, deja vu is French, so definitely
yes.
I can.
Well, I think it's actually jamais vu is the real one. Never seen.
Very good, very good, very well done. And then why making processes and data access easy as possible is critical for you?
Yeah, so that highlights what I call the last mile problem. You may have done a great job web scraping and a great job getting your data into your systems, but if you don't have the data in an easy way that everyone can access, quants or fundamental analysts, it's not going to be used. So we've actually invested quite a lot in these visualization tools to let everyone be able to access it very easily. And I'll just leave you with one last little story, where we like to think of our analysts as in a similar situation as Winston Churchill in the war rooms of London. If you've all visited those war rooms, it's a really amazing experience. But he was down there in the war rooms. But what was amazing to me is he had walls and walls of plots and graphs. He could see weapon production, troops, movements, and all this. And we really want to let our analysts have their own war room walls where they can figure out what it is they need to see for their own controversies, hypotheses. So having good technology to allow them to click, 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 and get to the answer in a quick way is really how you have scale to allow yourself to do lots of web scraping, to bring in lots of alternative data sets, and just make sure it's easily accessible to the analysts. And so that's something we found that's very important to have an investment in.
Interesting. We'll come back to that idea about generals as well, you will see. Next, maybe Judith. So we've seen you were focusing on the application of quantamental analytics to sell-side equity trading. And I have one first question for you. As your activity is related to market making, I guess that intraday and low latency streaming technology matters to you. Can you explain a little bit more why and how?
Oh, sure, Jean-Philippe. Thank you. Thanks for the question, and you're spot on. So before applying any trading analytics, whether it's a result of AI or machine learning or big data, or even just good old traditional statistics, we need to build a robust, low latency streaming analytics platform. Especially it's critical for the trading, equities trading or market making desk. And what that low latency streaming analytics platform does is it joins multiple data streams in real time and calculate desirable analytics upon data arrival. There's no gaps, right? There's no gaps on time. And those analytics can then direct an actionable item. It could be an act of updating bid and ask spreads, or risk adjusting size of the bid-ask offers, or adjusting portfolio optimization, trading risk management. So a streaming digital infrastructure is a very required baseline to provide continuous adaptive trading strategy, which is the key in trading, because everything about trading is real time. You can't go back and do something. The streaming analytics platform listens to all the data, including market data, news sentiment, macro data, fundamental data, and does analysis cross sections, and which is the backbone of our strategy. So I always regard an infrastructure is the muscle and the bone to our quantitative approach for trading desk, and it's inseparable. It's not just a quant research, but also the infrastructure that's critical to us.
Okay.
Yeah.
And so I understand you are combining market data, news sentiment, and other type of data in your market making and risk management process. But can you explain a little bit more exactly what you are doing with such type of data? And I'm very interested in knowing how you assess the value of each type of data, whether you assess that at one particular moment, that market data is going to be more important than the news sentiment or whatever. How do you assess that value, relative value between each?
Sure, awesome. So I'm just going to use an example between market data and news sentiment data. So these are both intraday. Market data is more frequent than news sentiment. But now let's say some news broke out on a company overnight on earnings. And we want to look at their overnight returns on a stock and combining the returns with the news sentiment. Right? We want to see, did overnight already react, overact, or react? How's the reaction on the overnight return? Was it an overreact or an underreact? Is it in tune with the news sentiment, the impact of the news sentiment? If it's overreact, okay, then we can take actions intraday the next day, right? And we will observe, okay, overnight already returned 20%. Is the 20% going to be 25% at the end of the day, or is it going to be 15% at the end of the day? So we look at return and the new sentiment interactively. Has the new sentiment been compensated by the returns already? So those like one case of joining, looking at some different data.
But then the big question is causality, and we have to find exactly because correlation is not causality. Everyone knows that. But how do you how do you proceed to understand the causality about all this data you are gathering?
Yeah, sure. So it's interesting how I came to think about causality in a space. So I was looking at some time series data that in theory, or from intuitive perspective, that should be highly relevant to stocks return and volume changes. So I did the usual thing. I did lots of feature engineering and tried various methodologies, from the simple ones to complex ones. And to my dismay, I couldn't find anything statistically significant in the data. And I couldn't understand why, because I couldn't accept it, because intuitively it's so strong, strongly related to returns. So that was the moment I turned my thoughts into causality. I wanted to find out if there's any true causal relationship between the two, and what is the causal relationship between two. And it was eye-opening. So what it turned out to be is that time series and return is bidirectional causal relationship. So sometimes that time series data is affecting returns, and other times return is affecting the particular time series data. So it's not all clear. That's why it was so noisy if you just look at it from a correlation perspective. And then along the way, I also discovered some latent variables, which is not as clear in the very beginning. So we can't just looking at the time series from one dimensional perspective. It actually has other things implied in it that makes it the return react differently to that time series. And causal analysis opened up all those areas that it wasn't looked at before. It was hidden underneath the rug. So that make us, the group, have a new focus on always looking into causal inference and causal sufficiency, which is actually not so different from what Jonathan mentioned before, from fundamental analysts, because they already have some causality in their mind. They already think, okay, stocks reacting this way because of this and that. So we're discovering it's crucial to always embedding causality into quant analysis, so it can be more stable, it can be more convincing, and it's also can be more explainable to the trading community.
Brilliant. And so Marko, you are doing research as well. Any views regarding that causality direction and how you are analyzing that? Because or on that ground, or maybe another, research is also failing at some point. Research is finding things that don't work, so that at least you can pinpoint exactly what works. Any experience you want to share about that?
Also, I mean, I've come across my share of spurious correlations that obviously didn't pan out, and I think that often happens in fundamental investing, where a PM might get married to a thesis, and it's called thesis creep, and happens more often than you would think. So what's nice about the traditional quant approach is that it allows for that rigor and consistency. And but the approach typically taken is I'm going to go an inch deep and a mile wide, make a whole bunch of bets, and ensure that I have at least 52% hit rate. Whereas traditional fundamental and discretionary benefits from sector specialization and the ability to recognize those situation-specific idiosyncrasies. So here, the approach is kind of that inch wide, mile deep. So you can't really can't cover as broad of a universe as you can with a systematic strategy. So in terms of kind of those spurious correlations and the ability to kind of eke out causality, I think fundamental guys are very good at that. I think the line here is getting fuzzier and fuzzier. Fundamental investors are already kind of quants in a way. They develop at times quite sophisticated valuation models. unfortunately at Excel still. That's going to change. And these valuation models 100% depend on inputs. They're like drivers of it, revenue growth, costs and margins, et cetera, which are in turn determined by things like the competitive pressures, costs of feedstocks, secular trends. So kind of elements that are embodied in the analysis of global macro landscape, Porter's 5 forces, et cetera. So in terms of causality, like that's where intuition, kind of human, can do quite well. So I think the use of quant methods in forecasting of these drivers can definitely enhance fundamental strategies, be it through obtaining better orthogonal data sets or using ML-based models to enhance the drivers. So I think blending quantitative with qualitative techniques kind of can help broaden the opportunity set. You can kind of look at various degrees of market efficiency by country and sector, et cetera. And what you want to do is obviously avoid the bulldozer approach by applying that industry specialization, that ability to home in on causality. And that also probably means, you know, that a bulldozer approach is obviously the one that newcomers to finance might take, kind of the ML blanket approach to predicting price. But in reality, fundamentals are either stationary or mean reverting. So it's much better to home in on seeing if you can better predict your fundamental drivers that and asking questions around those, because those are ultimately going to inform your thesis and investment decision.
Okay, and Marko, bear with me because I will ask a question right after and give a short answer on my side, but maybe you will add something different. So I'm very interested in knowing about that. We were talking about Quantamental as a mix of fundamental and quantitative strategies. And the question we get asked a lot by our customers about this approach is whether it can be applied to all asset classes and strategies. And of course, on our side, we believe yes, but it's important to mention that it's not binary in our way. It's not a matter of being black or white. It's rather 50 shades of gray here. It's the 50 shades of Quantamental. And for instance, we would have multi-asset target allocation strategies, which are more fundamental than quant, because we have to take into account various signals from central banks, etc., which happen not so often. And we are supported by quantitative signals, or on the other spectrum, we have a multi-factor fixed income strategies, for instance, where we are way more quant, of course, than fundamental. They use a pure quant model, but yet combined with a number of judgmental decisions, notably when we're putting the market, the bets on the market in our strategies. Marko, how do you see that spectrum? And because that question leads to another one, which is, should we intervene as humans in the process, or let the pure quant process and have a play on the risk budget or whatever? What's your view on that?
Yeah, I think here's where we're talking about kind of that spectrum. Right? There's a pure play quantitative, which traditionally has been, the idea has been, do not mess with the model, let it run. And then there's the pure play discretionary, where there is really kind of a, you know, valuation model, and everything is basically decided based on the intuitions of the analyst. And I think at this point, other than the kind of fringes of quant, where it's purely model driven, most successful fundamental discretionary funds are to some extent quant or quantamental. They bring in loads of data, they analyze it using fairly sophisticated methods. And I think Jonathan's approach is quite correct here. Was it Kahneman, I think, who said that no one ever made a decision based on a number, they needed a story. So to the extent that you can kind of bring in just the right amount of data, present it in just the right way to help you create a storyline that informs your thesis properly, I think that's the winning strategy. Like for example, from news data, like a relatively novel way to look at it is look at news co-mentions between companies. Is there a novel relationship being formed, and can it inform your thesis? Is it that two companies are evolving down a certain event path towards a fraud event? It's something that could certainly inform your thesis, and doesn't necessarily have to be quantitative, pure play quantitative in nature. I think you can layer on quant methods in portfolio construction, sizing, the timing, the entry and exit based on apparent crowdedness metrics. But in terms of data, one has to think about acquiring information that is orthogonal to what you already have. So that's another quant method on top that you need to layer on, that's not necessarily alpha generating, but certainly an important one to have if you care about your budget.
Okay. Jonathan, as you were mentioned, what is there anything you would add on that? Your mic is on mute. You know, the phrase that everyone hears about for the past year.
Yes, you're on mute. Yeah, so I think that when you really think about that spectrum like you're talking about, I think what works best along that spectrum is going to be different for everyone. And it's really all about cultural fit and what's consistent with the views of the organization. I think even the example of macro data, I think there's actually a lot of room for data science and alternative data with respect to macro, where just think everything that happens on the stock level, you can bubble up to the macro level and get early reads on payrolls, inflation, many other series, just by being creative with your underlying data sets. And so that's a natural extension of using quantitative or data-driven approaches to help inform both fundamental and quantitative investors. Because of course, a fundamental manager would want to know what the next on-farm payrolls print would be. That would obviously be very important to them. And so just using data science tools will help them, as well as help the quant manager who wants to just trade ahead of that announcement.
Good. Judith, any further comment?
Yeah, I think this all makes sense and comes into coming together. There are different. There's a continuum on how we mix and play quantitative and fundamentals, and a lot of times it takes some common sense, and a lot of times you need to pass by the basic trader intuition test as well.
Okay. And so this, although I mentioned we're working with 50 shades of Continental, every time I'm saying that, there is someone asking another question saying that, but we have to draw a line, a line separating between what we're, how we are using either quant or fundamental. And that line, I think one way is to look at the number of occurrences. The larger the data sets involved, the more the quant approach can be, and vice versa. So for example, stock picking from the S&P 500 index will favor a systematic approach based on quantitative techniques, be they factor investing or any other poison you want. Whereas assessing the impact of quantitative easing by central banks will be judgmental. So you see, it's always a matter of navigating between all these. I also think the main common point we have about all this is humans. It's going to be either humans who will analyze what the best traders or the best portfolio managers have been doing over the years, and then put that in a systematic approach, or those same humans who are going to be taking into account new models, new strategies, new data sets to be implementing their strategies and with the targets we mentioned about outperforming overall. I already see, and I've got a few other elements to mention on my side, and I see that there is one question from Michael Rains, very interesting one, that I want to be taking here. I will be answering in some way, and we'll let the other panelists answer as well. That question is, do you see organizations working more than previously to integrate the quant and fundamental teams? much too often they are kept separate from each other, and I relate to that. What's the best way to uniting the investment groups regardless of their approaches? I will propose here something based on some experience I had. So again, I've been working for quite a long time. And if you can imagine what was BNP Paribas Asset Management, quite a traditional Société de Gestion asset manager 15 years ago or 20 years ago, well, there were no factor investing, there were not so many data sets as you can imagine. The quantitative techniques were limited. We already have a few quant researchers, but we were not at all at the same scale. But overall, throughout the years, you may also know the motto of our bank is the bank for a changing world. So we have to adapt anyway. We have to be taking into account new developments. And for me, there are three moments that you can expect when you are trying to, in a large organization, to bring those type of strategies. Remember, we started from quite zero quantitative strategies 15 years ago, and now we are managing overall 150 billion with some form of quantitative. So 3 steps, 3 moments that you are going to be observing. And I think some of you will be relating about that. The first one is expect resistance. We're not talking about the resistance like the Luddites in the 19th century that are destroying, you know, the sewing machines and sabotaging those. But it's resistance because the quant methods are new. And very often they are new and they are full of mathematics. So people will be reluctant about that overall. And everything that is new, however visionary and efficient, will face resistance. But the way to tackle resistance is to be evidence-based. We have to show evidences that we are having better performance, control the risk, etc., etc. So to tackle resistance, the first thing we had to go was to go for evidence regularly. The second point was perseverance. It is perseverance because you are going to be in front of a lot of doubt. There will be doubt because at some times the model seems not to be working. The risk sizing ex ante doesn't correspond to the ex post risk. The models will also not be quick enough to integrate the most recent data. The factors will not work as we are experiencing this year as well for some factors, at least they are not there. So those are humbling moments. It happens, you have to embrace that. And the only way to succeed is to explain again and again that those strategies are based on fundamentals, exactly the same ones as the traditional portfolio managers are using anyway. So that's only that quantitative portfolio managers are augmented because they can leverage the technology and the large data sets. So definitely, in face of such moments of doubts, you have to persevere and rinse and repeat the messages regularly. And the third point I can see is pragmatism, because those systematic strategies, again, as we have seen, they don't work in some point. You have to incorporate new realities. You have to incorporate new data sets. Every day, you can imagine every day there is a new data set. There is something that didn't happen in the past. So at some point, you have to take that into account. ESG is a very good example. You need quality data over a very large number of companies, a good process to analyze it, and people to make sense of that data. And we often say that history is repeating itself, but in Quantamental, the good thing, because we're pragmatic on that approach, is that we are not stuck in the Groundhog Day, you know. And to take back the phrase of Jonathan, you can imagine Churchill in his war room. The main problem would be to be trying to fight the previous war. trying to just look at the past, but not anticipate what can happen, what are the different moves in the market. So overall, because there are going to be regime changes, you have to be adapting yourself. Well, one thing maybe you certainly have noticed, but we have calculated a few figures about that regarding the regime change. The equity market is strongly volatile, and more often it's getting more often volatile than before. We have measured the 5-day realized volatility over the 3 months realized volatility ratio. When you take that ratio since 2015 for the past 5 to 6 years, we measured six events where that ratio is over 3, compared to 6 similar volatility events in the previous 50 years, dating back from 1965 to 2015. So obviously, there are regime changes, and you can't be stuck in your systematic strategies. In our view, you have to adapt because realities are changing. So overall, my message here to answer that question, quite a long time, but yes, organizations are sometimes stuck in those polar world. They don't completely integrate, but that's not exactly what we're seeing. We're on the contrary, seeing that after repeating that message regularly, after being pragmatic about, yes, acknowledging that some things don't work, but what are we doing to take that into account extra, then we can develop ourselves and successively ensure that everyone will be benefiting from that augmented status thanks to the data sets and technology. Anyone from the panel would have another view about that, another answer?
Yeah, I just give some examples to support what Jean-Philippe has said in those areas. So about a decade ago, when we introduced quantitative signals to fundamental analysts or even to sector traders, the first thing they'll say is, if we say, hey, look at this pairs trading, this one is cheaper than the other based on co-integration stationary analysis. The first thing they'll say is, well, stock ABC is cheap for a reason. And we got just shut down right away, right? We were like, okay, there's no fundamental reasons to put on risk on this pairs. And it happens all the time. It keeps happening all the time. Nowadays, I actually got asked by sector traders, hey, can you give me some quant signals? Can you just highlight what's going on in the space? Just give me some technical signals, quantitative signals, and just highlighting what are the movers. What's making what stock is behaving abnormally based on history. They want to see it. They want to start their day with those signals to start dissecting into their sectors and see what's going on there. So one thing I would say is, if we want to introduce in more quant signals or quantitative strategies to traders to the group who are not as familiar, is to start with something simple. Is instead of giving them all the jargons and all the machine learning niceness of that, we just tell them, okay, look at these reversal signals or mean reversion signals. We're looking at those pair signals. So something they can absorb, like intuitively to them, and saying, yeah, it makes sense to me because it has been outperforming and probably has been overdone for years, for the last few months. So that's a nice way to introduce the non-quant sectors of the organizations into the quant space. I think people are very receptive these days to understand what's going on in the quant space. The second question to regime changes, yes, we have to be adaptive every day, because one thing about regime changes, it's hard to define. Is it a regime change, right? Or is it just a head fake? We have this value growth rotation happening multiple times over the last couple of years. And not every time is a true regime change. So we do need to be adaptive all the time, just following the data, following the machinery, and to figure out if there is indeed a regime change. If there is indeed one, yes, we do have to change our strategies. Yeah.
Okay, we're getting close to the end of the panel. We've got 5 minutes, and I see another question. Do you know if there are already open investable AI funds based on NLP, causal, RL funds available in the market with observable track record? On my side, not so sure about that. Anyone in the panel would have a view about that?
Rentex medallion is pretty good, but oh, it says open investable, right?
Yeah, that's maybe the concern. Okay, so back to the organization integrating more and more of those strategies. At RavenPack, I guess you are, of course, selling those data to those large companies. Do you see that as well? That it is only used by small departments, or that everyone actually is interested in those data?
Yeah, well, traditionally the client's been, a quantitative hedge fund, a market making desk at a bank, and I think the primary reason was it's kind of a low latency type of data set. We receive news data, parse it, and structure it in a pretty systematic, quick fashion, and within 250 milliseconds, it's streaming to the client, and it's very, very granular. So you need to tame the signal. You need to have that quant knowledge to tame the signal in order to either input it into a trading strategy or to generate insights, whatnot. But more recently, over the past couple of years, we've been seeing a significant influx of interest from fundamental discretionary guys and even corporates. And that's something that we're looking at quite closely, because it is kind of an education type of effort, because the data is so it's sparse in one way, because the news on a given company don't come that frequently, but at the same time it's high frequency and very granular. So you need to kind of know how to manage it and how to tame it. But there's a ton of creativity around how to construct a signal or generate an insight out of that type of data. So yeah, we're seeing a trend shift there. And we think it's here to stay.
Okay. And you, Jonathan, how does it work at AllianceBernstein as well? Is it separated or more and more integrated?
Yeah, I think that the trend that Marko highlighted is something that we're seeing as well. And I think I'd like to link that question back to the comments about how different organizations are combining quant and fundamental. And for us, and I think a lot of other organizations, it's really about incremental successes, where can you find some data set, like the news data set from RavenPack, and figure out a way for the quants to use it, as well as to find a first step for the fundamental analyst to use it. If you try to jump 10 levels in complexity, it's going to be complex. It may make a mistake, it may have an error, and then no one will use it. And if you think about, even in the quant hedge fund space, the most sophisticated funds in the world, lots of them started by just trading 5-day reversal. That was the first signal, and then they added another signal, and then they added another signal, and they added news. And even for the most sophisticated players, we all try to start with from first principles, from the most basic levels. And so that's an approach that we found that's effective, to really start from what's orthogonal and additive to the analyst, and help them make that first step, as opposed to jumping too far and getting them something fancy that they won't ultimately use. Because really, it's all about ROI and impact, and finding that first step is really the most valuable step.
Perhaps I can tag on to that. I think that's the right approach in terms of quantamental. I think it's asking the question and answering that question, as opposed to, I have all this data, I'm going to back test it. There's a Sharpe of 1.2, let's go. I think in terms of fundamental quantamental, there's a specific question you want to ask. And I can think of, like, when you trade bank debt, for example, and you get into a data room and there's a ton of granularity, and you can kind of gain significant insights that are not available publicly. But if you can quantitatively arrive at a fraction of such granularity, you're already ahead of the curve. So it begs the question, like, what is the question that you're trying to answer? Be it around operating margin reversals, or something around competitive landscape, or demographic trend shifts? Can you answer it using one data set or two data sets? And if you can, and prove that that's the case, then already you have a differentiated insight.
And we have a very good question from Munir Falafel. Munir is a former colleague of mine, so I will take that with pleasure. Sovereign wealth funds are shifting to Quantamental since they are big allocators to passive index data. What has been your experience? Very quickly, and I think because Judith also will be having some thought about that. Very quickly, we definitely see a lot of interest on this ground. They look for us to be sharing a lot of quantitative research. We have a large group of quant researchers, and definitely they spend a lot of time explaining as well to that kind of customers what we are doing in that field. They are not necessarily looking for the most recent elements. They are also looking for sound approaches that have been working for based on fundamentals that have been working for quite a long time, and they like the factor approach of analyzing equities or fixed income, and definitely that type of customer we think is the type of knowledgeable customers that is more and more going to be helping us spread the right word. Judith, any word you want to have in conclusion?
Sure. So I actually worked on a quant buy-side fund before my current job, and even 5-6 years ago, sovereign fund has already jumped on something called smart beta. And we see a lot of inflows in smart beta, or called active beta, which is exactly the passive index beta as written by the person who imposed the question. But it's very quant driven. It looks at it skews the fundamental weights on different factors, and then constructing portfolio that way. We've seen lots of sovereign funds inflow, even back 5-6 years ago. Yeah.
Okay. I think we're close to the end here. I wonder if anyone would have a boiling remark that they want to be sharing with us. And I do remember your what you mentioned, Jonathan, at the beginning, and it was very, very interesting. Anyone has an anecdote or a thing like this to conclude? Maybe not. No, if we don't have any further question, I think we're done. And it was nice having you again tonight. Well, night for me, but this afternoon for you. And I hope everyone enjoyed what we were discussing today. Thank you, everyone.
Yes,
Thanks,
thank
everyone.
you very much. Thanks, Judith.
Thanks,
Thanks,
Jean-Philippe.
Marko. Thanks, Jane. Jean-Philippe.
Thank you, Judith. Jonathan.